Welcome everyone to another video about the basics of stock investing. The stock market is what connects buyers, sellers, and brokers to the stocks that are registered with the SEC in the US stock market. The SEC is the Securities and Exchange Commission, which is an agency of the United States federal government that is created to protect investors and traders by enforcing the laws on the publicly traded companies. The goal of the stock market is to make it easy for anyone to buy and sell stocks. The process is easy to the point that from the comfort of our homes and with few clicks, we can buy stocks and be one of the owners of a bank, airlines company, car manufacturing company, and companies in different industries. There is a confusing thing about the stock market. I think it's being an auction market, which means that the stock price is not set and it is always changing. The stock price is based on what the shareholders are asking for and what the buyers are bidding for. This is different than what most of us are used to, because when we buy products and services like food, fuel, or cars, we accept the set prices of these products and services, because we don't have the choice of providing an offer that is less than the shelf price. Let us take an example for how the stock market works. Let's say that 10 shareholders of Microsoft Corporation are asking to sell their stocks for $100 a share, and 5 bidders are asking to buy it for $98 a share. In this case, the transaction will not happen because the two prices are different. But if one of those 10 shareholders change the price to $98, then the transaction will happen, stock ownership exchange hands, and the price of Microsoft Corporation stock is $98. Another scenario is when one of the 5 bidders change the asking price to $100. Then a transaction will happen, stocks ownership exchange hands, and the price of Microsoft Corporation stock is $100. The frequency of this process that I just explained is very high on any given day, because big trading companies use algorithms to make this bidding and asking process. And maybe the use of these algorithms explains the frequent change in the stock's prices every day. Almost every country has a stock market. For example, the US stock market, the Tokyo Stock Exchange in Japan, and the London Stock Exchange in England. There are 2 main exchange markets that form the US stock market, and they are the New York Stock Exchange and the NASDAQ. The NASDAQ stands for National Association of Securities Dealers Automated Quotation System. According to the NASDAQ website, the US stock market has 8,348 public companies in 12 sectors and 142 industries. You can imagine, if you have that many companies in the stock market, it is not easy to know how the whole market is doing. For this reason, statistical indicators were introduced to track the performance or the change in prices of the stock market. These statistical indicators are called indices. Examples of US indices are the S&P 500 index, the Dow Jones Industrial Average Index, and the NASDAQ Composite Index. Finally, an investor or trader can complete buy or sell orders in the stock market directly. And here it comes the role of the broker. A broker is a licensed company to execute buy and sell orders in the stock market. The broker also has other functions like keeping track of the investor's stock's ownership, receiving and holding dividends, and preparing tax forms so investors pay taxes on dividends and capital gains that is result from selling a stock with a profit. There are many brokers that are licensed in the US stock market. Some of them provide $0 commission. Some of these names are Fidelity, TD Ameritrade, Charles Schwab, and First Rate. In the next video, I'll talk about the different types of investors. If you like this video, please subscribe and hit the like button.